Welcome to Retire Smart, the uninitiated guide, the show that cuts through financial jargon so you can craft a retirement you actually understand. I'm your host, Tennille Alonso. Now, picture Lisa, a 61-year-old teacher who just got her first pension slip. She smiles until she spots a line for taxes. Now, wasn't she supposed to stop having paycheck deductions after retirement? Today, we unpack Lisa's surprise and help you dodge it. If your combined pensions, NIS, annuities, and side hustle income tops over $7,500 a month, anything over that faces the exact same tax brackets you had when you worked. Let's see how Lisa got tripped up and how you can stay clear. Now, Lisa's teacher's pension added up to $6,200 per month. Her approved annuity, which is guaranteed income, was up to $2,000 a month. And then she had a craft market side hustle of about $1,000 a month. So in total, Lisa earned in her retirement $9,200, which means that $1,700 was over the tax-free cap and was taxed at 25%, which means that Lisa was paying taxes of $425 that she did not budget for. Now, according to the Board of Inland Revenue, pensions and approved annuities, they fall under the tax reader once the income is 7,000 or above 7,500 a month. So every extra dollar jumps straight into your normal tax bracket. And of course, look at NIS. Those payments count towards the same $7,500 allowance. So if your NIS, let's say it's $3,000, you've already used 40% of the tax-free room before your main pension hits the bank. What is the role of, let's say, your side hustle or let's say your rental income? Well, that is treated exactly like a salary and it operates at the full marginal rate. So if you're selling pepper sauce at the craft market or renting a studio apartment downstairs, expect BIR to want its slice. So what could we do? What are the three perhaps easy things that you can do to keep more money in your pocket? Well, the first thing is you want to know what is your income. You want to add every source of income before you retire. So you want to look at your NIS, your pensions, your rental, your hobby sales, all income. You must be able to know what that is. And the second thing is you want to spread big payments. So if you're due a lump sum gratuity, why not ask HR to pay part this year, pay part next year to avoid a one-time tax spike? That's one other way you can look at things, particularly if you're getting your gratuity a little before you go into your pensionable period. The third thing you can do is to use allowable deductions. Why not consider an extra deferred annuity contribution that could bring your taxable income back to someplace under 7,500, or look at other tax incentives that may exist that could assist you in reducing your taxable or chargeable income. Now, I'm sure Lisa wished that she tested her numbers sooner. So don't repeat her surprise. Why not grab the Retire Smart Essentials Toolkit PRO and land one of our 12 free coaching slots? And if you're on a tighter budget, the basic toolkit, which is only $180, could assist as well. The links are in the description below because a smart plan is better than a tax mystery. It was my pleasure to have you here today and for you to understand a little more about how taxes operate when we retire. But why wait for retirement? You need to plan sooner rather than later. So do get some support, get a plan in place, and put yourself in a position to retire smart not by accident, but by design. I'm your host, Tennille Alonso, and I'll see you at the next episode. Take care. Bye.